The REIT market is vast and versatile, and just because two companies share the REIT acronym doesn't mean that they have anything else in common. To give you an example, you probably agree that the fundamentals of a REIT in the US that focuses on farmland are completely detached from those of a REIT in Africa that specializes in cell towers. Even then, REITs will often trade as a group as if their fundamentals were closely correlated with one another, and as you can imagine, this often leads to mispricings, with some REITs being overrated and others being underrated. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to highlight two REITs that I think are very overrated and then two better alternatives that I think are severely underrated at the moment. But before I get started, I want to remind you that you can access my entire real money REIT portfolio by joining High Yield Landlord for a 2-week free trial. This is a real free trial in that you won't be charged a penny in the first 14 days. So you can join, you can have a look at my portfolio, all my research, and if the service is not for you, you can cancel, you won't be charged a penny. So the first REIT that I think is very overrated is called Getty Realty. Its ticker symbol is GTY. And the REIT that's very underrated compared to Getty, in my opinion, is NNN, ticker symbol NNN. I actually think that Getty is a pretty decent REIT. They have a management team that's well aligned with shareholders. They have a unique strategy that has historically produced good results. And I think that based on their balance sheet and portfolio, they are likely to keep delivering consistent and predictable cash flow for a long time to come. Moreover, the company is today offering a 6.5% dividend yield that I think is safe and likely to keep growing at a slow pace. However, I just don't see the point of buying Getty when you could buy some of its close peers like NNN REIT, which are far better diversified, have stronger balance sheets, better long-term growth prospects at a very similar valuation multiple. In fact, Getty Realty is actually a bit more expensive than NNN REIT today. The FFO multiples are more or less the same, but keep in mind that NNN REIT is using less leverage, it owns better assets, so if you adjust for that, the multiple of Getty Realty is actually higher than that of NNN REIT. However, NNN actually is superior from every perspective. It has a better portfolio, stronger balance sheet, and better long-term growth prospects. So let's start here with the portfolio. Both of these are net lease REITs, but they have very different portfolio structures. Getty is highly concentrated on gas stations, whereas NNN REIT is much more diversified, focusing on all the main resilient categories of net lease properties that are service-oriented, such as convenience stores, quick service restaurants, pharmacies, dollar stores, and so on. In case you're not familiar with net lease properties, you should know that gas stations are typically considered to be riskier assets because of two key reasons. Firstly, the growth of electric vehicles, or EVs as we call them, could very negatively affect their long-term profitability. And this is because if you think of the business of a gas station, typically it attracts people to the gas pumps. They don't make much money on selling the gas itself, but then people will go inside the convenience stores. They will buy some higher margin products like a coffee, a drink, some groceries, and that's really where the gas station makes money. But the problem now is that as more and more people buy electric vehicles instead, they won't go as often to gas stations, because even though they start installing these electric charging stations, most people will keep charging their vehicles at home. And once they go on longer trips, they will much rather charge their electric vehicle at a restaurant while they're eating because it takes time, or while they're at the grocery store, rather than at a roadside convenience store like a gas station where they'll be bored and not have much to do. But so what it essentially means is that the visits to gas stations are likely to drop over the long run as more and more people buy electric vehicles. And while this won't immediately affect the profitability of gas stations, over the next 10 to 20 years, it could start to negatively impact their valuation, their profitability, and suddenly the gas station market could become oversupplied. And then the second issue of gas stations is that they can be very expensive to redevelop into other uses because of potential environmental issues. Removing fuel tanks often requires soil remediation or even removal and backfill, which is very expensive. Moreover, there is also significant liability risk for the property owner, because if you then tear down the gas station and there's no concern at the time, but then you build something new on top of it and later there is a complaint because of potential environmental hazard, you may need to tear down the entire new property just to fix these issues in the soil. For these reasons, back when I worked in private equity in Texas and we're buying a lot of net lease properties, we typically stayed away from gas stations. Their risk reward is just not that attractive in our opinion, because yes, they trade at higher cap rates because of the higher risk. But if you're long-term oriented and eventually go through one of these worst case scenarios, you'll probably change your mind about gas stations and want to stay away from them. NNN REIT, on the other hand, as I mentioned earlier, is much better diversified. Its exposure to gas stations is very small, and it's well invested across different types of resilient service-oriented properties. Therefore, even if you disagreed with me and thought that gas stations are relatively attractive net lease investments, you would still probably favor NAREIT here because it's better diversified, which means that it's safer and you're not paying a premium for it. Typically, if you're taking more risk, you need to be compensated for it with a higher risk premium. But in this case, NAREIT is actually the cheaper REIT, so you might as well invest in that one instead. Then NAREIT also has a much stronger balance sheet. Getty Realty has a pretty decent balance sheet as well. It has a roughly 40% LTV. From the top of my head, its average debt maturity is about 6 years. Don't quote me on that. It might be 5 or 7, but about 6 years. And so it is going to have some debt maturities in the coming years, which will increase its interest expense. On the flip side, NAREIT has an LTV of about 30%, so a bit lower than Getty, but importantly, its debt maturity is also a lot longer at over 10 years on average. It has some of the longest debt maturities in the entire REIT sector. I think it's something like 13 years, so about 2 times longer than Getty Realty, and so it's going to be much less affected by the surge in interest rates, which is a big advantage. This is also reflected in its stronger investment grade rating. NAREIT has a BBB+ investment grade rating. Getty Realty, I think, only has a BBB-, so just one notch above junk. If it suffers any setback in the future, it could be quickly downgraded into junk, which would significantly increase its cost of capital, so that's another risk to keep in mind here. And then finally, NAREIT is also likely to grow at a faster pace over the long run because, as I mentioned earlier, it has a stronger portfolio, so it's less likely to suffer some setbacks. It has a stronger balance sheet. It has better access to cheaper capital. It also retains more of its cash flow. The payout ratio of NAREIT is today in the high 60s, whereas Getty is in the low 80s. So retaining more capital allows it to buy more properties to keep on growing at a faster pace. And so this faster growth rate is also well reflected in its stronger past returns. NAREIT has massively outperformed Getty in the past, and I just don't see this trend of outperformance ending anytime soon, given what I explained earlier. This would be different, of course, if Getty was priced at an appropriate discount relative to NAREIT, then perhaps this lower valuation could make up for the advantages that NNN is enjoying. But given that NNN is the REIT that's the cheaper one, despite being the stronger REIT, I just think that it offers much better risk to reward at this time. And for this reason, I think that Getty is overrated and NNN is underrated. Hey, before I go into the next REIT, please let me know in the comment section below what REIT you would like to see covered next. And also, if you think that this content is valuable, I'll really appreciate it if you click the like button. Thanks so much in advance. Then the second REIT that I think is overrated is called Boston Properties. Its ticker symbol is BXP. And the REIT I'm going to compare it to that I think is underrated is called Alexandria Real Estate, ticker symbol ARE. In this case, Boston Properties is a bit cheaper if you compare their FFO multiples, but again here you need to make a few adjustments. Boston Properties is focusing on higher cap rate properties which justify a lower valuation multiple. It also has a bit more leverage. It's going to be more impacted by the surge in interest rate. It has worse growth prospects. I'll get back to all of that, but if you make all these adjustments, actually the valuation multiples are more or less the same. If you look at their price to NAV instead of the price to FFO as an example, they're actually very similar. Alexandria is really not priced at any major premium, perhaps a tiny bit more expensive, but the difference is really not material, and yet it's a far better REIT in my opinion. So let's again here start with the portfolio. Boston Properties owns mostly traditional office buildings. These are Class A properties in strong coastal markets for the most part. But even then, the office sector is today struggling. Occupancy rates are the lowest since the great financial crisis. And they are in the low 80s today. Boston Properties is doing a bit better, obviously, since it's focusing on premium properties. But even then, its occupancy has been declining. The incentives that it needs to give its tenants have been rising, including the tenant improvements. It's going to have to reinvest more heavily in its properties in the future to keep them desirable in a very competitive marketplace. Insurance might be declining a little bit as well, and so that's something you need to keep in mind. Now we compare that to Alexandria Real Estate. That's a REIT that focuses on life science properties for the most part, and they are much less impacted by the shift to hybrid work settings because you cannot conduct lab experiments from home, and you also cannot safeguard all this valuable lab equipment and intellectual property in your home either. Moreover, it's also important to consider here that Alexandria has relatively long leases. It has, I think, 8 years left on its leases on average. Those leases include 3% average rent escalations. These are triple net leases, so the tenants are typically responsible for all property expenses, including even taxes. insurance, even the maintenance in some cases. So the cash flow is highly predictable in the case of Alexandria, even as the lab space also faces a bit of oversupply today. And another important point here is that its current rent levels are deeply below market. And so this provides margin of safety in case as leases expire in the future, because its tenants are unlikely to find a better deal elsewhere. And on top of that, it also provides a bank of growth, because eventually the oversupply of the lab space is going to again turn into undersupply. And again, it has years left on its leases, so it's protected today. And let's say as its leases now expire 3, 4, 5 years from now, it's likely going to enjoy some quite nice rent bumps. Historically, it's been able to readjust leases 15, 20, 30% higher. And I think that this is going to be the case again in the future. Then the second reason to favor Alexandria over Boston is its stronger balance sheet. It's a similar case as Getty versus NNN. Boston Properties has a higher LTV, it has much shorter debt maturity, so it's going to be more heavily impacted by the surge in interest rates. On top of that, also lending has become a bit tighter in the office property sector. A lot of banks don't want to lend against offices anymore because they predict that they are going to suffer losses on those loans. Alexandria, on the flip side, has one of the best balance sheets in the entire REIT sector. Its LTV is even below 30%, I believe. Its debt maturities are around 12 years as well, just like NNN REIT, so very long, some of the longest in the whole REIT sector. So it's not heavily impacted by the surge in interest rates. It's much better protected. And then finally, Alexandria has much better growth prospects than Boston Properties, in my opinion. Better assets, rents that are below market, long leases with strong rent escalations, better balance sheet. This is going to result likely in stronger growth over the long run when compared to a traditional office REIT that's facing a lot of problems. And already historically, Alexandria has been growing at a far faster rate. It has resulted in much stronger total returns over time. And again, I just don't see that ending anytime soon, given that they are priced at similar valuations, but Alexandria is much better positioned. If anything, this outperformance may even accelerate going forward. Therefore, once again, we have a REIT here that's overrated, Boston Properties in this case, and one that's underrated, Alexandria, in my opinion. I think that these are great examples of how the REIT market will often misprice different companies relative to others, and it shows you that you need to be very selective to optimize your performance. And if you want to access our entire real money REIT portfolio, you can join High Yield Landlord for a 2-week free trial. We invest a lot of money and time into building this portfolio. I think I've invested well over $100,000 in research to build this portfolio, paying my analysts, paying different research subscriptions, and you get to access all of this for free with the 2-week free trial. If you decide to stick beyond the 2-week free trial and invest for the long run with us by following our research, the fee is still very attractive, I think, compared to what I'm putting into this. Thank you so much for your consideration. And then finally, if you could please click the like button and subscribe to the channel if you think that this content is valuable. That helps me a lot to keep on growing. Thank you so much in advance. See you at my next one. Bye-bye.